Hello, today is Tuesday, the 24th of February, 2009. Brian Shannon from Alpha Trends here. We had another volatile session, and the markets, for the most part, got back yesterday's losses. NASDAQ is just a little bit negative on the week right now, but we didn't see real convincing volume in here. We are still below the 10, 20, and 50-day moving averages. And for now, we can look at this market as today's action is nothing more than a little bit of a short squeeze from oversold conditions. We'd seen the 28 level briefly violated with yesterday's close. The market expended a lot of energy coming down to this level, and I was thinking that if it continues lower, then we would see the next potential level of support down near this area here at about 20 just below rather $27 a share. And if we look at the 10-minute time frame, what we saw in here today is we did see a slight gap higher, and then the market continued to rally. Let's take a look at the 1-minute time frame for that. The market continued to rally a little bit, got real choppy back and forth above and below the daily VWAP in there, and really was just trading more in a range until later on this afternoon after Chairman Bernanke got done speaking, and that's when we saw some further upside with a little bit of volume confirming these up moves. Each little up leg in there. Got a little choppy again towards the end of the day, but there were opportunities, as there always are for nimble traders. Bigger levels remain up ahead as far as potential resistance, just around 2960 obviously has been a very important number. But when we look at the 10-minute, let's look here on the 10-minute time frame. I didn't draw that quite right, so let me grab it and pull it back up there. But the 2960 level remains an important level, obviously. We broke this slight downtrend, but nothing to get excited about. You could make the case, as we've made the case for in a lot of instances, that maybe it pulls back, it creates a higher low in an inverted head and shoulders pattern. It's almost laughable how many of those inverted head and shoulders patterns we've seen in this market only to have them fail. So you can't look at these intraday reversal patterns and put too much faith in them. We want to keep our attentions shorter term than that and focus our decisions based on what the short-term trends are telling us. So right now we've got this level right here that we had pointed out yesterday, about $29.30 is our potential level of resistance. And then the bigger number that's been pretty well defended here last week was 29.60. If somehow the market can get it back above 29.60, then we have it back above the 50-day moving average, and it just means that we're back into this range, which is what we're back into the middle of the range. We're obviously staying within the range in the NASDAQ here that we've seen for the lows, for the year that rather. Yesterday's closing low, by the way, of 27.86 was just slightly lower than that 29.15 close that we had, or 27.96 from January 20th. So the market did make a closing low for the year, obviously, and we'd seen 12-year lows in the SPY and that sort of thing. But volatility is what remains the only consistent thing in this market, which is why you have to continue to focus on those shorter-term time frames. Looking at the 30-minute time frame, we saw that the market got up to that 5-day moving average, kind of paused under there a little bit, but did push back above it, and here in the last hour, and actually held above it. Problem is, we've got a declining 5-day moving average. More important than where it is in relation to any particular moving average we look at is what's the direction of that average. And again, moving averages aren't a trading system; they're just something to compare price trend to. So what I'd really like to see right now is perhaps we get some support down near about $28.30. If this market pulls back, I think that's our first level of defense for the buyers. Obviously, 28 remains important, and the lows from Monday. If we give those up, then we've got to look back to the daily time frame and wonder if we're going to come back down towards this 27 area. So remains a very tricky environment in here. I'm suggesting still that it's best left for day trading. So no clear trend in here. Maybe we're seeing a little bit of sideways action as perhaps we see tomorrow a rally up towards that 29.20. I'll outline what I think is the ideal scenario. Rally back up towards $29.20, $29.30, and then a pullback that holds above that 5-day moving average, and then a push up to $29.60. Let's see what happens there. We've got Obama tonight, so if you're betting on this, it's just a bet. Anything can happen. But we've gotten a little oversold here recently, and I was looking for and kind of hoping for a big washout, a big, real heavy volume, fearful decline. From there, then I think that we would have a better chance of a rally that could sustain itself for more than a couple days. But instead, what we see is just more continued choppy action, and you have to just trade on the short-term time frames pretty conservatively, because these markets are just so choppy. The financials were up 12% today, so big percentage movement, or up 87 cents. They are up on the week now, short 2 days here, but they're up 8% on the week. So they're obviously, again, pointing out, emphasizing the fact that you can't stay with a position in either direction for very long, especially if you're trading the FAS and FAZ. And again, I'm going to tell you that if you haven't looked at it, you need to look at those prospectuses they send you in the mail, and it says in there very clearly that the returns of those triple levered funds are not meant to match the performance for anything longer than a day. So be aware of that. We are still, or are we? Let's see. We closed at 805 today. The low from January was 807. The close here at 808. So we still are below January's lows on a closing basis. The last couple green candles, we're seeing a little bit heavier than normal volume as compared to the last 20 days. But obviously, in this market, we've got all kinds of levels of potential resistance ahead. This area is where we are, and that's, again, the January closing low. Above that, a more important level is going to be found at about $8.60. And then we can look, start looking at some of these other numbers, such as $9.40, which has been important. This market did get extended here today. I think a lot of shorts were feeling the pain as it rallied, and maybe new shorts getting covering as they realized that the market had too much strength in there today to be doing any short selling. Ideally, same thing in here. Let's take a look at the potential support levels. This high at about $7.70. 760 to 770. I think that's going to be an important level for this market to hold on a pullback, because 760 is not only this little high here from a couple days ago, but it's also the level where we find that now flattening out 5-day moving average. So ideally, I'd like to see a pullback towards that 760 level on lighter volume relative than what it's been advancing on here, and then maybe a push higher to go do some work on some of these other numbers. Obviously, it's a badly damaged market. Markets correct through price, and they correct through time as they wear participants out. So still, you can look at these and say they're down too much. It's a value. We've got maybe a little bit more clarity from the government, but we don't have clarity as far as prices go, and that's the only thing that is going to end up paying you at the end of the day. Russell 2000 was up 3.6%, or with its gain of $1.46. Let me change the scaling here a little bit. But this market obviously has been one that we've been very concerned about. It seemed as though maybe it was due for a test of these lows. For now, we've got 1 day's respite, but there's only trading average volume in here, and still very possible that we could go down and test those lows, maybe make lower lows. It would be good to see, I think, on heavier volume, and a nice washout move there. But for now, we had a day of looks like basically some short covering. This market got up to its declining 5-day moving average. This market has been rejected by that 5-day moving average over and over again in this market. It's also this level, or just below this level here, at about $41.60 that we've been watching. So we've got a declining 5-day moving average. The market halted at that level today, and we had seen it also in its inability to get above this prior level of resistance that was support here. We've got all kinds of other levels up ahead for this market that are likely to give it trouble if it can get moving higher. So 43 is going to be a bigger level, obviously. As far as potential support goes, I think that these highs from yesterday afternoon and then this morning. If this market can maybe pull back towards that level on lighter volume and see this $40.40 level hold as far as support, creating a higher low, then perhaps it could build to push back above that 5-day moving average and push back above that 4160 level. That would pave the way for perhaps another day or two of upside that brings us to that 43 area. It's still way too dangerous, I think, to hold overnight for any such move, because we still have the risk of this daily time frame, which is obviously got a declining 10, 20, 50, 100, 150, 200-day moving averages. They're all declining. None of them are even crossing yet, indicating the indecision that we want to see at the beginning of an accumulation stage on the weekly time frame. But this market obviously just remains very risky, best left for day trades. Same basic pattern that we'd seen in the Qs, although this one obviously was a little bit stronger, maybe not so obviously, but it got above the morning highs right in here. And then we'd seen a nice pattern of higher highs and higher lows. Later in the day, we did see a slight lower high and starting to give up a little bit. So perhaps we see a test of that $40.40 level. If $40.40 doesn't hold, then you're going to be looking at these lows once again down near $39.50, and of course breaking that could be what leads to the fearful, for what we've avoided as far as that big fearful washout. The SPY was up $2.83 or 3.79%. Yesterday we had seen a closing low since this bear market began, and basically a 12-year closing low as well when you look at the monthly time frame. And here though we hadn't quite gotten below this low from last November on an intraday basis, but again, the closing low was more of a headline grabber. And today we saw a little bit heavier volume, but still nothing to confirm, to convince me that this is the beginning of anything that's going to be significant as far as a turnaround. Always want to be open-minded to anything, but let's look at 78.50. That's our first potential level of bigger resistance. I think that pull back down towards 73.30 or so. 76.30 would maybe create that higher low in this inverted head and shoulders pattern, and then that would potentially pave the way for a test of the 80.5 area that had been so important as support back here, and then resistance last week. So still a big mess in here. I'd still like to see a big heavy volume washout before we can have any confidence that a rally can hold for more than just a couple hours, really.